Ladies and gentlemen, without any further ado, it is time to kickstart with the first panel discussion on global economic trends affecting private equity. Recent months have seen a number of political and policy changes influencing trade, economies, and capital flow. In our first panel discussion, we shall hear our esteemed panelists' insights on these global changes which are influencing the investment theses and decision making by private equity investors. Let's begin by welcoming the moderator for this panel, Janet Rodrigues, Managing Editor, South Asia, Bloomberg. Janet oversees coverage of one of world's fastest growing economies and region that is home to about fifth of global population. Very warm welcome to you. Please have a seat. Please help me welcome Ms. Ashley Minnis, COO and partner. Mr. Ashley Minnis, COO and partner, Chrysal Capital Advisors LLP. He has been with Chrysal Capital for 24 years. He's a member of the advisory committee and is responsible for diligence, regulatory, industry relationships, legal compliance, and operations. Please put your hands together to welcome Manish Kejriwal, founder and managing partner, Kedara Capital. Kedara manages over US $6 billion through investments in several market-leading businesses across a variety of sectors, including consumer, financial services, pharma, healthcare, technology services, and industrials. Up next, we would like to welcome Pooja Sondi, partner, Shardul Amarchand Mangalas and Company. She is a leading advisor with expertise in foreign investment and regulatory affairs, mergers and acquisitions, venture capital, growth capital, and private equity investment, joint and corporate restructuring. Please put your hands together to welcome Roshni Bakshi, Managing Director, Private Equity, Everstone Capital Asia Private Limited. Based out of Singapore, Roshni's role includes driving value creation in investee companies across all verticals in the areas of high-performance teams and human capital management, brand transformations, and ESG, including impact. Prior to Everstone, she was the CEO and Managing Director for the Walt Disney Company's consumer media and retail business for South Asia. Last but not the least, please help me welcome Sujit Govindraju, Managing Director, PVC and India, Office Head, CPP Investments. Sujit leads CPP Investments portfolio value creation team in India. He works with portfolio companies on value creation opportunities across functional topics and due diligence on significant potential investments. Can we please have a round of applause for all of them? So I'm sure this is going to be a brain-stimulating and thought-provoking session, and we're looking forward to dive into it. So I humbly urge the moderator to please take it forward.
Thank you very much. And thanks for the introductions. It gives us time to dive straight into the meat of the matter. Indeed, it's a stage of turmoil in the world. Everyone in the finance industry, of course, loves this. Turmoil is a good time to make profits, to cut deals, to really negotiate and understand where everyone stands on a certain issue. So let's lay the stage first by asking each of the panelists one simple question, and I request you all to be brief. How do you see the world changing today? Let's start with Sujit on the extreme.
Right, thank you. Well, I think it's the last 3 to 4 decades, most of the countries have been aligned on a common agenda of prosperity, right, which has been set by an aligned international rules-based trade and investment order. The biggest challenge that I see is are we on the verge of that order potentially breaking down? Like if you think of countries who are focusing a lot more on national interests versus multilateral interests, focusing a lot more on changing your industrial policy or security policy, and what is that going to do to the economic ramifications? That I think is probably the biggest challenge of our times, and this is all a relatively new phenomenon. So the stability and predictability of a rules-based international trade and investment order, I think, is the challenge right now.
Roshni, same question to you. Everstone, of course, has operations across, but it also has got a massive for the domestic market. How do you see the world changing, really?
Like I was telling you, Janet, I think I see it changing almost every day now. You wake up every morning and there's new news. So it's obviously creating a lot of uncertainty, and I think Sujit explained a lot of the economic and investment order of the world is changing. But more importantly, I think it's highly volatile at this time. And we can see that in the way the stock markets are behaving. Domestically, I think India is still in a good place, even though there's been a slowdown. But the way we are looking at it is we need to wait and watch.
Thanks, Roshni. Pooja, the lawyer on the team here of bankers, how do you see the world changing, and also how is deal making evolving?
So thanks, Jeanette. Good morning, everyone. I think just to add to what Sujit and Roshni said, I think we're changing from a world of multilateralism to a much more multipolar geopolitical environment. I think with all the tariffs and retaliatory tariffs, sanctions, and dynamic trade policies, I see a movement from global trade policies to much more dynamic bilateral trade policies. Now, what I think this will mean is, together with this whole multipolar geopolitics, it'll be accompanied by an evolving regulatory landscape, and like Roshni and Sujit mentioned, lots more volatility, unpredictability, very difficult to predict the trajectory of changes or even interest rates or financing costs, making deal making much more complex. I think despite the global economic uncertainty, Indian deal making has continued to be resilient on the back of strong fundamentals, political stability, as well as economic reforms that our government has put in place. But I think more than ever, I'm seeing a convergence of business, law, and geopolitics that advisors and businesses and investors have to together assess, strategize, and scenario plan in order to manage these risks effectively.
Thanks, Pooja. Certainly a busy time for the lawyers. That much we can guarantee. Manish, same question.
It's always a busy time for lawyers. First, thanks to Nupur and everyone else for having us here. It's great to be back here. I agree with most of what Pooja said about we're really moving from a multipolar world to a unipolar world. But the good thing, which we should appreciate, is frankly, as India, which is relatively insular from a trade flow perspective, and not from protection, but because the majority of our goods are made for our own country, and we're not that import dependent. In a world where global tariffs, when you wake up every morning, is a negotiation, luckily being insular will work to our advantage. And let's face it, we're relatively irrelevant from a Trumponian worldview. I mean, I think Canada, Mexico, China, Russia, frankly, we should be humble enough to realize we'll be the consequence of those actions. So we need to be, as a country and a leadership, very smart about staying under the radar and engaging on levels which it's to do the anti-Zelensky Trump show, not be upfront and be under the radar as a country, and work towards, and I think we will need to open up certain areas, but I think the government will probably do it smartly and open up more high-end motorcycles or drones or AI. I don't think they will interrupt or try to do the pharma lobby sector. I think will stay. So I think on the macro level, as far as we are concerned, frankly, as private equity, the world doesn't change that much. I think at least the majority of the firms represented here invest primarily in India. Yes, we have both Ashley and Roshni and Everstone and Chris and us, an increasing focus in the US. So we have to be careful, but that's only on select verticals. But otherwise, I think, I don't want to be arrogant and say everything is hunky-dory, obviously, but the challenges will be much more country-specific for us. For example, we all increased our pace of exits last year. We had 3 exits. You probably will have lesser this year, but that's given the state of the capital markets, not so much a Trump event. And number 2, the good thing with that is everyone, all of us who have significant dry powder will deploy more when valuations correct, as they should this year.
Thanks, Manish. Speaking about significant dry powder, Ashley, certainly the world is hunky-dory for you. You're raising big money. Do you see the world changing?
No, so I'll come to that in a second. But I think I just echo the sentiments of the other panelists, right? I think the world is getting a lot more protectionist, and so people are getting a little insular. We all of us on the stage and all of us probably in the room who are investing in India may not have as much of a problem because, as Manish said, we are focused on businesses that will grow here. I think as a country, the good thing is India is sort of, and I know they don't use the word non-aligned anymore. We've aligned with partners and friends on the international arena that sort of help us, right? And so that's a good strategy to sort of stay under the radar, be good friends with many countries and not get under the radar for others. As an industry, I think, to your point about dry powder, so the one thing where India is still dependent on overseas is in terms of fundraising. So all of us in the room, I mean, as an industry, still about 85% of the capital comes from other countries, and the domestic pie is growing. It's sort of grown to about 10-15%, but it needs to grow a lot more. And so to that extent, I think our industry is a little vulnerable and dependent on what's happening around the world. And hopefully, as an industry, we work towards growing that pool of capital. How do we grow domestic so that we're not dependent on what happens outside?
Thanks. I certainly want to come back to that fundraising question. But I want to turn to you, Roshni, at this point, and pick up on something Manish said, where he said that the pharma lobbies, et cetera, will stay the same. It's unlikely that certain sectors will see a massive change in policy. Everstone, of course, invests largely in health tech. There's the broader technology world as well, but health is a big space for you. How is your business dealing with these changes? What is the thinking within your firm?
Yeah, so, and I think Everstone primarily invests both in healthcare, technology services, a little bit in industrial. Industrial is more domestic for domestic. And if I was to split out healthcare itself, there's services and products. In services, it's domestic for domestic, which is really hospital and all allied services around it, which as Manish and others have said, there is enough domestic demand that will continue to keep the growth and more. When it comes to products, we do a lot of generic drugs that are manufactured in India, and yes, shipped to the rest of the world, including parts of it in India. Now, in the rest of the world, US does form a significant part because we do what is called as cross-border deals, where we have revenue coming in from the US, both in tech and healthcare, as well as and all the delivery and the manufacturing in India. In pharma, our belief is that if you look at what Trump has done, there is tariffs that is coming, or there will be some level of bilateral tariffs. However, at the end of the day, the generic drugs that India is able to produce are so margin thin and wafer thin that even if there is an increase in that price, it will still continue to be competitive. And today, India does. Around 50% of the generic drugs in the US are from India. So while we see that there could be some level of tariffs, possibly, we don't see that as a huge issue at this moment. That's pharma. Now, when it comes to tech services, that's another one that has been constantly in the news about the immigration and H-1B visa and how cheap labor is going into the US. In our case, we focused a lot on delivery centers and all the back end being in what we call as low-cost countries, and most of it in India, and just the revenue-facing functions in the US, where we tend to get, we tend to actually get talent, which is Indian, but with local citizenship. So again, we are buffeted. Now, is there a risk? There could be a minor risk, but we don't see that as a huge issue where we're concerned.
Thanks, Roshni. And picking up on what you said about the H-1B, the immigration issues there, I want to catch on to Manish and ask you really, you have a planned US expansion. Are you rethinking that, or how do you see the US-India relationship evolving vis-a-vis your business?
Listen, I'm Marwari. We're understated. I don't think what Trump does to the world will be relevant to what we're so small and insignificant that I don't think we'll show up anywhere. So let me first explain. I mean, the last thing I want is a headline that says we're going to the US. We're not. But let me step back and say, how do we look at life? And I think I'll speak on both our behalves to a certain extent. I think I know Ashley thinks similarly as Chris Capital does. We first focus on what we, in private equity, life is relatively straightforward and simple. All you do is you make 3 or 4 investments in a year, and hopefully you exit as many, right? Once you're a more stable engine. Those 3 or 4, the most important thing people don't talk about is what you don't do. So actually, when we look at investments, we don't touch infrastructure, we don't touch real estate, we don't touch a whole variety of other sectors, which is either regulated, where the government is involved, or where they're very large businesses, conglomerates, who will have much more ability to influence change than we would. So we don't want to play in that value chain, and we want to remain simple and under notice and stay below the radar in a sense. So below the radar is maybe 20, 30% of the economy. For us, there are 4 verticals that are important. We love and have always focused historically on financial services. That's still probably the largest part of our portfolio, a number of deals for sure. The second, which we've grown over the years as we're only 12 years old, has been consumer and consumer tech. Those 2 we believe, and here Ashley will disagree, that we're probably the best, and I don't say that in terms of our teams, and we'll probably get the deal that we want in the market. I do think on healthcare and tech services, which are our 2 other sectors where we do some deals, not a lot, we are still to evolve to a situation where a Bearings is, where maybe even an Everstone is, certainly where a Chris Capital is. So in that context, only for software tech services is the so-called US expansion. It's not even a US expansion. I think maybe some members of my team will travel to the US more often. But I think on a serious note, where we were losing 2 deals to all our competitors is we were conservative. And also most of the deals coming in the sector were banker run. So our absence in the US, we were only seeing intermediated deals and not. So what we have done is actually hired 2 people. We have a very strong operating partner model. We've taken the Clayton DeBellier model and Indianized it. It's a 40-year-old model. So we have some very senior industry veterans across. So we have someone like a Keki Mistry helping us with financial services. We have a Vendi Banga and another one joining us soon on the consumer sector. On the tech services, we hired Abid. Abid was the ex-head of Wipro. He was the CEO of Wipro, lived in Dallas, still lives in Dallas. And a guy called Chris Baker, who took a $100 million company and made it $700 million for a company called SoftServe, and he's on the East Coast. So those 2 are the new hires, our so-called US expansion. It's not a US expansion. We plan feet on the ground, no offices on the ground. We definitely don't want to be in the radar of anything which is in DC. And it's no surprise that that has resulted in 2 of the last 3 deals happening in tech. Again, very small companies. None of these are even headline material. But for us, if we take a $100 million company in revenue and make that into a $500 million revenue company, which we can easily do in our holding period, that's a 5x increase in revenue. Hopefully, it'll be a 7 or 8x increase in EBITDA. Even assuming there's no multiple expansion, which there typically is, that's a phenomenal return. So our life is relatively, when I said it's being very simple. It's not worrying about the global trade flows, etc., especially if it doesn't concern us. And not to clutter the mind, it's to keep life simple.
Keeping life simple and staying under the radar is every Marwadi ever, but everyone pays attention and should pay attention to them, and we certainly are paying attention to you, Manish. Talking about staying under the radar, talking about infrastructure, Sujit, you're next. Who would have thought that Canada would pick fights with everybody around the world? How are you seeing the situation? I mean, probably your firm is most interestingly poised in terms of geopolitics than the rest of the panel members here. So sorry to put you on the hot spot, but how are you seeing the situation?
Well, I definitely don't claim to be a geopolitical expert. But I guess right now the tussle that's going on in North America, I mean, if you put it in the historical context, just my 2 cents, Canada and US have been partners for a very, very long period, right? They have a shared history, they have deep cultural, people-to-people ties. Supply chains in the continent are built across the regions there. And I don't know how many of you know, like 30 of the 50 states in US, for them, Canada is the biggest export market. Canada is also the largest exporter of energy to the US, right? And defense, this probably the closest between the regions, the partnership itself, right? Well, I think the current situation is such that the strongest of bilateral relationships are being tested. But having said all that, in the context of CPPIB is actually built for times like this, right? We are built for times of uncertainty. We are built like a super tanker, slowly and steadily charging forward, irrespective of the political cycles, irrespective of the macroeconomic cycles, irrespective of the tenures of presidents and prime ministers. We continue to charge along because we are built with a very simple purpose. Our purpose is that we are relevant. We are a thriving pension fund for the Canadian pensioner 25 years from now. And that's what we evaluate, and that's the way we asset allocate, and that's the way we distribute. And for us, the key here really is that diversification strategy. How do we diversify and stay relevant that we can take advantage of many different cycles? So we invest across regions, we invest across asset classes, right? Unlike Manish mentioned, we do invest in private equity, but alongside great partners like Kedara, we do co-investments, and that's where we maximize returns. We invest in infra, we invest in real estate, we invest in renewables as well, and we believe we have the ability to go take that risk and then really create commensurate returns for it. And these are stable asset classes for us, and we understand that very, very well, especially in regions like India, where we are one of the largest toll road operators, one of the largest industrial warehousing operators, majority owner in country's largest renewable development operator, so on and so forth. Apart from owning about 13 unicorns, where we are generating good returns. We also invest in public markets, which is again a big chunk of what we invest in globally. And also then credit. Credit, for instance, in India is a relatively new strategy for us over the past 4 or 5 years, but has really allowed us to invest in areas that we wouldn't have otherwise touched. And it's 3 billion out of the 30 billion book in India is in credit. So that's how we are beating it, right? Like last year, I'm sure our friends here would agree, last year we felt private equity valuations were very high in India. So, but the team then found this incredible opportunity in a company called Keyword Solutions, and that's a good example. It's a London-based IT services company in gaming where we put in $500 million. The team that did it is out of India because they've had great knowledge advantage of having invested in the space, and we were able to get that deal done. And that was a that we are very excited about, right? Similarly, we've then invested in, on the other end, something like NHAI, which is a roads InvIT, I think government's most successful asset monetization program, and we anchor that 25%. And today I would probably argue amongst road InvITs or even infra InvITs, probably one of the best yield returning asset class out there, so very stable from our perspective. So net, look, I think it's, we are a $710 billion super tanker going towards $1 trillion. We need to think about diversification, and diversification is our secret sauce to beat this uncertainty.
So I planned on coming to Ashley next, but I'll take a break from the financiers saying the world is screwed, but my company is fine. So I will change my plan a little bit and go to the lawyer for a reality check. Pooja, what are you really seeing in terms of exits? And from your vantage position, where you're supposed to play the devil's advocate, is it really all hunky-dory?
So look, I think again, which is the theme across this panel, that globally, of course, the holding periods have been much longer. The exits have been not as much as people would have liked to see. The average holding period is no longer 5 odd years, it's closer to 7+ years. But India actually is in a better situation. Last year, we had actually quite a remarkable exit here. There was, more than 26.7 billion returned in terms of PE, VC exits. And of course, this is largely as expected, given the very buoyant Indian public markets. Almost half of that was basis open market exits. We saw Blackstone emphasis, Ant and Zomato, multiple very big ticket open market exits as you would expect in these markets. There were also a large number of, I think, 40-odd PE-backed exits. Manish had a big one, Vishal Megamart, and lots others, Swiggy, First Cry. So across the VC growth PE spectrum, we saw multiple PE-backed exits. Secondaries, again, big trend on the exit side. I would say after open markets, probably the second biggest source of exits, which is playing into the theme of, Ps still being interested in getting into mature companies, which have been kind of risk fenced and, the fundamentals made stronger by an existing PE and providing liquidity to the exiting PE. So I think secondaries is another theme of exits that we think will continue to grow, which is PE to PE. On the exits of PE to strategics, of course, that's lesser, again, to be expected when the public markets are booming. But having said that, the largest exit last year in terms of Bharat Serum, which was for Advent, selling out to Mankind Pharma, was a strategic. So I think that in terms of thematically across all four segments, I think exits will continue. Secondaries especially. This year, again, we have a long backlog of exits, IPO-ready companies. We have seen a big trend of VCP-backed companies reverse flipping back to India, re-domiciling to India. And there's a very, very strong pipeline of that, aided by the government push, especially for regulated companies to be domiciled in India, as well as making the process, the regulatory process, much quicker. Now you don't have to go through the court process. You can actually get it done very quickly in 3 to 4 months. So I think maybe the IPO markets we expect may not be as robust as last year. I mean, we've seen some corrections in the last few months. But I think over the next 12 to 18 months, we will continue to see companies coming of age, coming through the IPO market, and definitely expect to see the secondary trend continuing.
Thanks, Pooja. Ashley, now your turn. A specific question I had for you, especially as Pooja spoke about reverse flipping, a government push to do business here. One reality that a lot of companies can't really miss is the FX depreciation and the FX volatility, really. You're heavily invested in IT services, which is at the forefront of any volatility that the rupee and the exchange rate sees. Is that a risk to investors such as Chris Capital?
So again, as a country, if you look at it, and we've been around for a few years, right, 25 years, we've seen the currency, the rupee, depreciate against the dollar, right? And so that is something that it's a treadmill. You can't, you got to live with it. You can't, you can't sort of completely. There are ways to hedge it, but there are limited ways to do it. So I think, over time there is volatility. I completely agree with you. But in the kind of investments we do, it's a sort of 5-year investment horizon. Sometimes gets stretched to 7 years, as Pooja said, right? But you want to do it in 4 or 5 years. And so over 4 or 5 years, hopefully that volatility will iron out, right? There'll be times where the rupee is stable relative to the dollar, and the times where it's a lot more volatile. I think that we've generally sort of, build into our model a 3 to 4% sort of depreciation per annum. So it ends up being, call it in the life cycle, call it around 15 to 20% depreciation on account of the currency. And that's for any deal that is focused on the domestic market. The reason why currency is relevant for us, again, is going back to my earlier point that, in our case, all of our capital has been raised, from foreign investors. So we get benchmarked against dollar returns. And so that's again, that's what we need to deliver. That's what our LPs sort of compare us against, global funds and domestic funds. But the benchmark is a dollar return. So you got to deliver. You've got to really, you're taking money in dollars, so you got to deliver that, right? And you're in a country where you're investing. So the enterprise tech, the IT part of it, actually in a way is a little bit of a hedge. But the domestic investments we tend to lose on account of the currency. The good thing is with there is some natural hedge within the portfolio, which is enterprise tech, which tends to be a lot more export-oriented. We do have some of our pharma companies again, or some of our, smaller new economy companies also, which have a little bit of an export aspect to it. So maybe about 30% of the portfolio gets a natural hedge between these 2-3 sectors. And then the remaining 70% you're exposed to currency. But I think, frankly, that's something we live with. And that's not something, I mean, there are ways to buy, protection against it, but generally, most people, I'm sure in the room, as well as our investors have told us, it ends up being a very expensive proposition, and most people, I mean, the success rate is not really guaranteed, especially in a country like India. So that's something we will live with, and so you build it into the model, and you know, as Manish said, you try and put it in and say, can you generate an expansion in revenue and margins, even if there's no multiple, and you take the hit account of currency, does it still make sense to do the deal? And that's an assessment you sort of try and build in at the start. Could it go, you know, significantly worse than what we had expected? Of course. Could it be better? Maybe. Probably not. I mean, most cases, we've only seen things go negative. We've never seen things, the positive surprises are few and far in between. But so it's something you live with.
Actually, sticking with you on the fundraising part, really, are you seeing the markets for fundraising changing in the sense that given the extreme volatility in the US with the news flow, every day we wake up to fresh headlines, do you think arguably more reliant markets such as Japan, etc., will become more important? How do you see this?
No, so I think two things. One is, you know, where can investors put their money, right? And if you looked at it about 10, 15 years ago, it was when we were out fundraising, we were competing against, why are we the best amongst BRICS? Why are we, you know, against China, against Southeast Asia, Brazil, etc. Today, our competition and the way LPs look at us is not these regions, but in the US, right? And they say if we can get, and the fact is the US has delivered, you know, good returns at a significantly low risk profile, right? So based in India, investing in India, there are significant levels of risk. You know, the risk adjusted return needs to be significantly better, right? So that's again something that we've been facing. I think a lot of our capital that comes into India, not just as Chris Capital, but as an industry, comes from North America, right? And that is a fact that is the case, right? There are pockets coming from Southeast Asia, there's some coming from Middle East. And it's good to have that diversification. Europe used to be prominent, you know, about 20 years ago, but I think Europe has had its own set of issues, so that the capital from that part of the region has dried up. You've got to live with some of that again. Japan is definitely very promising, but our limited knowledge of that region is it takes a long time to convert. I mean, in any case, our fundraising cycles are, you know, conversion from first meeting, and Manish, I'm sure you'll echo this, to actually putting money in, probably takes 4 or 5 years between an investor, right? You go introduce yourself, and they'll watch you for some time. And with Japan, I suspect the cycle is a lot more. But the good thing is, you know, again, at a national level, there's a lot more push. So, you know, I know we, you know, were part of an event which was hosted by the Indian ambassador in Japan. And we got, you know, I think 60 odd Japanese LPs to come. And so I think, you know, the point again, I'm part of a few industry forums as well. And the part that I've been trying to propagate is that, look, we're all in this room selling India. And it's our job to sell India and sell ourselves. But can we leverage the government of India as well? And so we've actually done a few of these things where I said, you know, in Japan we got the ambassador to host it in the Indian embassy, and that, you know, and we were talking about India. It was not just us; there were a whole bunch of, you know, folks there. Similarly, we did another event in Singapore. So I think that's another good thing, that as a country, you know, we now realize the importance of selling our industry, and when it is sold as a country, saying, look, this is what are the value propositions, I think it's a great thing, because we want to attract capital into India. And now when people come into India, they may choose to go with Manish, choose to go with Roshni, whoever, that's fine. But at least the capital is coming in, and we need that capital, you know, until we are able to build a domestic pool of capital that can counter that.
Thank you. We started a bit late, so is it okay if I take 5 minutes more than what we were? Because I want to throw this fundraising question to the others as well. How are you all seeing your fundraising patterns changing, or do you all see a change at all?
No, so fundraising has changed. So I agree with everything that Ashley said in terms of, you know, where the funds are and what the opportunities are today. Specifically, one of the things that LPs have started looking for is now exits, right? So as long as you're able to show that you have effectively returned capital with the kind of returns that they're looking at, they're ready to put in the next level of you know, investment back into your new fund. So it's become very clear that people want to see value coming, and then they're willing to put value back. So the way we are looking at, for us, fundraising We started fundraising now. We are on our 5th fund. And given the kind of returns that we've been able to deliver, where our 3rd fund is concerned and our 2nd fund, we're seeing capital being looked at extremely positively where we are concerned. Again, I think, as Ashley said, today when capital looks at where can they invest, and if they're looking at diversification, there is not too much left. There is US, which is still, despite the volatility, despite the fact that if you look at the equity markets right now, they swing almost every day, it still is seen as a relatively low risk market. And then there is India. Europe is, going through its own pains. China is in a very different situation. Of course, there is some green shoots that have happened, and suddenly over the last few days, we've seen the stock market go up. But I think investors have got extremely wary about how China has been behaving, and that's a question mark. There is, of course, Japan, but it's very different. So, when they look at portfolio allocations, at the end of the day, it ends up being India. And therefore, if you're able to show your performance, I think the better Indian funds get it. And surely, if you look at Kedara as well as Chris Capital's recent performances, they've been doing extremely well.
Yes,
Been
Manish
1.7 and 1.4 is pretty good where India is concerned. Very good, I must say.
Manish does seem ready to add.
2.5.
He gave us a headline.
Work is in the room.
Manish, you seemed ready to say something.
No, I think this is a topic close to heart because actually it has to be fun doing this. I want to actually be a little bit serious and step back while I agree broadly where Ashley and Roshni have gone. I think one needs to be careful when one says, "Arey, there's no other place money will come automatically to India." That's not the case in my mind. From a pure risk as an LP, whether it's Sujit or 10 other guys, it's a risk-reward trade-off. There's no affinity to India. Because Sujit is Indian doesn't mean he's going to pour more money to India. And today, let's face it, from a risk-adjusted perspective, just the US market itself is more than adequate to suck all the liquidity in the world, right? Why do people go overseas? It's for some degree of diversification. And from that perspective, yes, from a BRICS perspective, temporarily our thing might be high. But I'll go back to my Marwari comment. It's actually purely performance, nothing else. It's performance, performance, performance. The country might suck. There may be a terrific money manager in China. I would much rather double up on that asset manager, given current valuations in China. If I know and trust the guy, and the mantra to what Roshni said, the DPI is the new MOIC. So yes, and it's not now, it's always been there. It's just more exaggerated today that you have to return. Our problem with Indian private equity was because the type of deals we did 15 or 20 years ago as an industry, it was minority, you had little control of your exit, you added minimal value for whatever reason might be. So there were hardly any exits. Today that's changed completely. So I think one, it's less to do about global flows because again, we're inconsequential. From combine all of our fund sizes together, we won't move the needle for any global investor. So let's face it, we're small, irrelevant. It has to be a performance, speaking for ourselves. Not money will come, not because China is slowing down. Money will come because we return money to investors, one. Number two, as GPs, we spend a lot of time talking about portfolio construction. What we have started increasingly doing is LP construction. So you said, Ashley mentioned Japan. Of course, Japanese money is very sticky. As Ashley said, it takes 10 meetings before they smile, 20 meetings before they commit capital. But once they do, it's sticky forever. But that might change. We all rushed towards Australia in, about 8 or 10 years ago. You know what's happened to the market? The regulatory changes. So it's tougher for them, for the superannuation funds to commit to external funds or middlemen. So all I'm saying is, to de-risk yourself, we had, for fund one, you do whatever you can, beg, borrow, steal. Well, hopefully not steal, but you beg and borrow. And we had our fund one, we had one investor who made up 30% of our capital table. Which from a riskiness perspective is ridiculous, but we had no choice. Today, so it's not just about where you raise money, is what is the combination of LPs, right? So we make it sure now that we would rather have a smaller fund than all the money that come to us. but we do it in a way that it's, one, globally diversified. Secondly, there's no one outsized. So our largest investor in a fund today is restricted to 7% of the fund, from 30 to 7. So tomorrow, I don't know what might happen to, let's say, a German investor or a French investor or a Canadian investor. My thing to the rest of my LPs and to my firm and all my team members is to ensure continuity. So even if there's a change in policy, which there is more than often, so where the global stuff becomes important, they might hit, for example, the state pension plan of Ohio or New York or San Fran. All of them suddenly can't invest in China. That might happen to India at some time. So we can't plan for that. All we can plan around that is say not be dependent on any one of them for a long period of time. And I'd say the final thing in conclusion, as an industry, we truly have matured. I think instead of the crab mentality of yesteryear, I think all of us on this thing try our best to make sure the more successful Roshni and Ashley are, the more successful we're going to be. So I'll give you one small example. There's no coincidence that we have a huge overlap in LPs. So Ashley and I do our AGMs back to back, and we plan for it. That would be unthinkable 10 years ago, right? You'd be competing, hiding, when is my date? You'll try to overdo the other. None of that stuff now. I'm just being practical on how the industry has evolved. It's common sense, but egos and hubris didn't allow us to do that.
The pie is big enough for everyone to flourish, and India seems to be in a bit of a fresh cycle that's really making our case. The quiet Canadian firm at the corner, I won't let you go unnoticed. Literally with an eye on the clock, Sujit, your very quick comments on fundraising, if I may, and also to wrap up the session, to each of you, where do you see the biggest risk?
Yeah. I mean, on fundraising, I completely agree with what Manish said. For us, I think we don't have the problem of fundraising, but I think we do have the hard problem of asset allocation. But I think, and there is no India reservation, 100% spot on. I think we look for where do we get the best dollar return, risk-adjusted basis, and India gives a great diversification benefit. But the one thing which has not changed is probably the quality of the partners and quality of the portfolio companies that we come in at, right? I think what we are very proud of is the track record. I mean, we were rated the best performing pension fund in terms of dollar returns for a 10-year basis for a reason, because we are very, very methodical with where we give our capital and the quality of those partners. That I don't think has changed across the cycles. So I think on the second question on the risk, right? See, I think it's an assumption risk. As an asset allocator, I think we all assume that there is a convergence path. Like if you think of an emerging market, it's a convergence path. Your GDP per capita increases, your economy opens up, capital flows in, and then over a 10-year basis, the investment universe increases. Right? That's the convergence path, right? What if that gets tested, and then countries start focusing a lot more on isolated and a lot more on social spending, a lot more on security spending, so on and so forth. If that convergence path of the country gets deviated, delayed, then how do you think of the risk of allocating to a specific country, and how do you think of the risk in terms of the geopolitical
Thanks,
issues?
Sujit. Time's up, but I want to ask all of you your rapid elevator pitch. One sentence on the biggest risk. Quickly down the line.
No, I think we're dealing with it. It's geopolitical, a lot of it, and trade. And in that, what are the opportunities? And I think Manish made a very, very relevant point, saying we're very small, we're a very different industry. We do look at opportunities at every stage. And we're too small to be otherwise impacted looking at the large one. We would end up probably just looking at what we get out of it.
Pooja?
Yeah. I think I'll just quickly want to talk about something we haven't touched upon today, which is AI and Gen AI, and how it's obviously disrupting and changing all the industries. And I think the related risk is the dark side of AI. And I think while there's a lot of money flowing into AI and how, whether it's AI tools or AI enterprise platforms, I think there is a big responsibility to make sure that AI is used responsibly, whether it's risks like bias and discrimination, or it's data privacy, data manipulation. So yeah, very quickly, I think dark side of AI and managing that very carefully.
Thank you, Pooja.
I'll be short. I really fundamentally believe it's ego and hubris. Ego and hubris at the country level, which says money will keep coming in where India is shining, so paisa aata jayega. And then At the GP level, that combined with complacency, the magic of last year of 2024 in terms of exits, one shouldn't put that in the business plan for the foreseeable future.
So I think a lot of the external risks we've talked about. I think one of the other internal risks, I agree with Manish on complacency. I mean, that similar word, just to stay disciplined. I think India is a market that's always expensive. There's always the temptation to get into an investment that you really may not be successful on. And so, can you stay disciplined and grounded around what you do?
Thank you very much. Thank you very much to our panel. And thank you very much to our lovely audience this morning.
Thank you. I request all of you to please stay back for a moment. I would also like to invite Mr. Kawaljeet, Managing Director and Founder from Fireside Venture, to present the token of appreciation. Could we please have a round of applause for him? Ladies and gentlemen, the giveaways are made by women entrepreneurs. WINPI is proud to give them a platform to showcase the skills. Can we please have a thunderous and a massive round of applause for all of them? Thank you once again to all our esteemed guests and dignitaries for sharing your expertise and insights and for addressing all of us. I'm sure we've learned a lot and we look forward to imbibing the takeaways. Can we please have a picture together? Yeah.